Hi, everyone. I'm Laura Adams. Thanks for downloading the Money Girl podcast. This is the second episode in a two-part series about 6 different retirement plans created for individuals, employees, and businesses. Back in part 1, I covered the first 3 accounts, so make sure to go back and check out that podcast, which is episode number 310. Today, we'll discuss the remaining 3 plans that make it easy to set aside money for retirement and slash your tax bill. Before we cover the final 3 retirement accounts, here's a brief review of the first 3 types that I already covered in part 1. Type 1 is the traditional IRA. This is a plan for individuals only. Contributions to the account are never taxed until you take withdrawals during retirement. Type 2 is the Roth IRA. This is also a plan that's only for individuals. Its major difference from a traditional IRA is that contributions are taxed up front. However, withdrawals of contributions and earnings during retirement are tax-free. For 2013, you can contribute a total of $5,500 to a Roth IRA, a traditional IRA, or to a combination of both. Type number 3 is called a 401k plan. This is a pre-tax plan for individuals. However, it can only be established by an employer. Just like with a traditional IRA, your contributions and earnings are never taxed until you take withdrawals during retirement. Now, some employers may also offer a Roth 401k option, where you make after-tax contributions that grow completely tax-free. For 2013, your total contribution to any type of 401k can't exceed $17,500 or $23,000 if you're age 50 or older. That's in addition to any amounts your employer may contribute on your behalf. The last 3 types of retirement accounts that we'll cover can be used by businesses or those who are self-employed. Type number 4, a solo 401k. A solo 401k is sometimes called a UniK or a one-participant 401k. It's simply a traditional 401k that covers a business owner and their spouse who has no employees, like maybe a freelance writer or photographer. You can make contributions as both an employer and an employee because you wear both hats. On the employee side, you can contribute 100% of earned income from the business up to $17,500 or $23,000 if you're age 50 or older. And as the business owner or employer, you can also contribute up to 25% of your compensation. However, your total contributions to a solo 401k for 2013 generally cannot exceed $51,000. But what if your business is a side hustle, like building websites or teaching music lessons on the weekend, and you also participate in a 401k at a second company? In that case, the total employee contribution you can make to both plans can't exceed $17,500 or $23,000 if you're age 50 or older. Type number 5, a SEP IRA. You may be thinking, well, what if you're a small business with employees? Well, one of the easiest and least expensive retirement plans to administer is the SEP IRA, which stands for Simplified Employee Pension. It's an option for any size business or those who are self-employed. With a SEP IRA, you contribute to a traditional IRA for employees, including yourself, up to 25% of their pay. However, employees can't make their own contributions. Employers can choose the amount to contribute each year, but must give all employees the same percentage. For example, let's say you have a small cleaning business with one employee named Sally. If you choose to contribute 20% of your pay to your SEP IRA, you'd also have to contribute 20% of Sally's pay to her SEP IRA. But if you have a bad year with little profit, you can choose not to make any contributions. This flexibility allows a small business to manage cash flow and have the benefit of a simple retirement plan that requires very little paperwork. Employees are always vested in their SEP IRA account, which means if Sally leaves your employment, she can take her retirement money with her. Type number 6 is a simple IRA. A simple IRA is another inexpensive retirement account option for any size business with little administrative hassle and paperwork. However, it's generally best for companies with 100 or fewer employees. SIMPLE is actually an acronym for Savings Incentive Match Plan for Employees. It allows employers to contribute to traditional IRAs. However, it's different from a SEP IRA because employees can also put money in their accounts. Remember, with a SEP IRA, only the employer can make contributions. For 2013, employees can contribute up to $12,000 or $14,500 if you're age 50 or older to a SIMPLE IRA. Employers with a SIMPLE IRA have two choices for how to make contributions to their employees' accounts. The first is called matching contributions. This means they can match what an employee contributes dollar for dollar up to 3% of compensation. In this scenario, if an employee doesn't contribute to his or her account, then that employee doesn't receive any contributions from the employer. And the second option is called non-elective contributions. This is where an employer can make flat contributions of 2% of pay, regardless of how much an employee puts in. In this scenario, an employee who doesn't contribute any amount to their plan will still receive an employer's contribution equal to 2% of salary. Either way, an employee is always 100% vested in all their SIMPLE IRA money. The retirement plans that I've covered in this series are the most common, but there are more than 6. IRS Publication 590, called Individual Retirement Arrangements, gives details about all the plans available for individuals. And IRS Publication 560, called Retirement Plans for Small Business, can help you explore options for your business endeavor. If you need help setting up a retirement plan or aren't sure how to use multiple retirement plans properly, be sure to contact a qualified tax accountant. Paying a consulting fee to get clarity on these accounts can pay dividends if it saves you taxes and helps you build a cushy retirement account for the future. To get more money tips and advice, check out the Money Girl Facebook page or follow me on Twitter, where my username is @LauraAdams. Also, we publish a free newsletter with extra content that you won't find in the podcast. There are links to everything I've mentioned on the Money Girl page at quickanddirtytips.com. You can even read a transcript of this show, which is episode number 311, called 6 Retirement Accounts You Should Know About, Part 2. I'm really glad you're listening. Cha-ching! That's all for now, courtesy of Money Girl, your guide to a richer life.